After this video, you'll know exactly how dividends work at DEGIRO. Not only that, I've been investing for over 10 years myself. I think it's been about 7 or 8 years at DEGIRO. When I started, I was still very young, so I don't remember exactly anymore. And lately, I've actually been focusing more on pieces. Dividend. Why? Because my wealth has grown. But I have to tell you, at first, I didn't really know how to easily find a dividend overview. So I'll show you that in this video. It's actually super simple. I have to laugh a little, but we're going to talk about dividends at DEGIRO. And not only that, because how it works. Dividends and also a bit about dividend tax is quite simple. But in this video, I'm going to give you a little sneak peek on how to find potentially the best dividend stocks. Okay? This is not shocking news. On our channel, I regularly make analyses of potentially the best dividend stocks, and I do that based on a few combined tools. But the added value is, of course, in picking out of the golden fish from that golden pond. And how you do that, I'll explain to you as well. Well, let's take a look at how dividends work at DEGIRO. I log into my DEGIRO platform, and then after the explanation of DEGIRO, dividends and taxes, I'll show you how to find potentially the best dividend stocks. When you're logged into DEGIRO, you'll naturally find an overview of your portfolio. And also, if you have ETFs, by the way, we're seeing a bad day in terms of returns today. And one stock in particular that's doing really badly, Advice Lab Solutions. Wow, almost minus 50%. I'm afraid that one is going to do very poorly. But anyway, these are good stocks. And you see many of my stocks are quite risky, with a few big outliers going up, but also down. But I'll explain that to you in the monthly portfolio update on my investments. So follow our channel, subscribe, then you'll stay updated on our monthly updates with some interesting positions. Recently bought a lot again. But if you're looking for dividends, there are a number of dividend stocks also in my portfolio. If you're looking for dividends, there are a number of dividend stocks also in my portfolio. Then you scroll down in the portfolio and you'll see under cash, compensation will provide an overview of the dividends that are announced. So you'll find the announced dividends here. However, if you want to see what the actual paid dividend is, then you go to the account overview. What you can do is, for example, change the date here to a year of your choice or start from the beginning. And then you search for dividends. You've searched for dividends. And here you find a complete overview of dividends. What has been paid out in the past few years. And that can be a lot, a whole series, or very little. This is definitely going back a bit further back, because he's even going to page 4. This is from 2022. And I've also filled in that date. So you can see that you've received various dividends. Over time, the only thing you can really do is this overview. Perhaps download, and then you can set it up in Excel, and then you can make an easier sum. That's, of course, easy to do in Excel. What you earn is the dividend. So in this case, the real estate fund Realty Income in my portfolio recently paid out a dividend. That was a few days ago, and the dividend was 23 euros. What gets deducted is, of course, dividend tax. Dividend tax is basically 15%. What happens at DEGIRO? Here, it's pretty well organized on this investment platform for dividend investors as well. Why? You have two types of dividend taxes. The Netherlands has a lot to offer. Countries have an agreement where you get taxed on dividends. Often it's 30%, and you can see that, for example, with an account like eToro. Unfortunately, many Belgians cannot invest through a platform like DEGIRO. And because of that, they choose, for example, eToro or another platform. eToro is based in Ireland, so it has a different tax system with 30%. But with DEGIRO, it's usually arranged that you have 15% according to the Dutch treaties. So that's really handy. So you basically pay for Dutch shares. For that dividend that has been paid out, you pay 15% dividend tax anyway. And you get that back in box onto 1 in your dividend tax return, box 1 and 3. That can always change, of course. So that can vary every year. But I don't think the chance is very big. Well, the second one is foreign. Dividend. You see a lot of stocks here, all actually from abroad. Realty income seeking. But here, the dividend tax is almost always present. 15%. And you can also get that 15% back in box 3 when you pay wealth tax. So that is indeed an exception. And in your tax return, you can see that clearly reflected the connection between DEGIRO and the tax return has been established. When you simply create your account in your name, then it's linked one-to-one, and then you basically just need to check if it's correct. So you can filter dividends for the year you want to see and convert it to, for example, Excel. And then you can always check what your dividend tax is and how much you could claim back. But you really need a lot of dividends to reclassify. And you want it all to be worth the effort to check, reclassify. And you want it all to be worth the effort to check. So that's about dividend tax. Let me show you how to potentially then find good dividend stocks. One way to find good or potentially the best dividend stocks. I'm going to explain that to you now. And I do that based on 10 years of investing experience. And one of the programs that has really helped me achieve higher returns with investing is Seeking Alpha. Well, this is partly promotion and partly not. Why is it partly promotion? Because I mentioned their program and we have our own affiliate link. That's a kind of promotional link where we receive a commission, 20% for every new customer. You can find that promotional link in our YouTube description or in the comments. I would appreciate it if you click on that. If you want to start using Seeking Alpha, why? Because it's free for 7 days, but you also get a discount of €30. So that's a win-win on both sides. However, I will only promote things if I'm sure it's going to help you, and I'm investing myself now for more than 4 years, also using Seeking Alpha. And thanks to this program, but also another program that I'll show you later, are we really achieving much better successes? So I'm 100% from my heart. The goal of YouTube is to help you, and we share a lot of status, content. My name is Yorick Vermeulen. I'm doing this in my own name. My reputation is at stake, and I'm not going to do that for a few bucks. I'm not going to put my reputation on the line for that. I firmly believe in that Seeking Alpha, one of the better programs there is that I have found to date, and also for dividend investing, super handy. Why? Their methodology is based on factor analysis. I'm not going to explain it all in this video, but factor analysis takes into account 5 categories: valuation, growth, profitability, momentum, and EPS, revision. This last part means that the expectations have been raised, that the stock will make more profit than expected. By stock, I of course mean the company. We see in this factor, algorithm, that momentum carries a very heavy weight within the total weighting. That goes from 1 to 5. And we see that here with contrating. If something scores high above 4.5, then it gets a strong buy signal. So here we actually see a filtering of dividend stocks, all of which score above 4.5. But if you go to Seeking Alpha to find and compare, you go to stock screeners, then you can screen all sorts of things. And then we go to top quant dividend stocks. And here's another interesting point, because these stocks are not only selected based on, do they have an interesting valuation that is relatively cheap or attractively cheap? So that's in the case of growth. Do they have good growth prospects? Are they profitable? Yes or no? Do they have strong momentum and an EPS revision? And there are also many pros and cons to it, but that's too complex to explain all at once right now. We're here to find the potential for the best dividends stocks. So you'll still have to do a lot of research yourself. But here we see, for example, vision, properties. I mentioned it before on our channel. I regularly share stock analyses for inspiration, and there are a lot of winners among them. Well, Vision Properties is also one of those stocks that I've mentioned in many of those videos. If you'd like to follow our analyses, it would be greatly appreciated if you subscribe. That helps us a lot. So for what? Super thanks. By the way, I also bought Vision Properties myself. Well, quite coincidentally, it's now at the top of the factor analysis. What does that mean? That means that statistically, it has a relatively high chance of succeeding in achieving above average returns. Compared to a lot of other stocks that are in the same data pool, note the same data pool, what's mainly in it? Stocks from the United States. What isn't included? Stocks from, for example, Europe. Let's quickly take a look at Vision Properties. And what you want to do is, for example, look at the valuation. But this is a real estate fund. So then we're talking about the price. Let's move on. Let's take another stock. For example, Ingredient. Ingredient is currently scoring a bit lower on the factor analysis, but still is a strong buy. How does that work? Let's take a look at the valuation. Then we see that the price to earnings ratio for next year is estimated to be around 12.5. We see here the sector median. So that means a price difference of 32% cheaper. He now automatically gets an A-. on the factor analysis because this is a difference of minus 32%. But it can happen that here it says a price to earnings ratio of 20 and here it says 25. Yes, then it's still cheaper than the sector median. But a price to earnings ratio of 20 might be on the high side for a company like Ingredient. So you really need to have the experience and skills to look at that very critically. Another very important thing, for example, is the loss ratio. Well, then you see the valuation. You've done your research as the first screening. This all seems okay, of course. Then the next step is to take a look. Is this really a good company to invest in? Because one big downside I find with seeking alpha is that mainly focused on the next 6 to 12 months. And you should really always invest according to the principles of Warren Buffett. Why? Quant investing is at the forefront of that. That increases the chances of success. So you mainly want to invest in companies that have high quality. One of the ways to find high quality stocks is by always looking at profitability. Here we see, for example, a net income margin of 9%. That 9% is indeed higher than the sector median of 4%. But in this case, Ingredient, just as a random example, is a food production company. It has no distinctive capability. For example, it's a food production company. It has no distinctive capability. No, sustainable, maybe a small one, but not super strong. Well, and I also happen to know because I've worked in the same industry, 9% is fairly average for the specific industry that Ingredient is in. So that 9% might be better than the sector median from this data pool, but 9% is really not special. So based on knowledge and expertise, okay, yeah, this stock might not be superior, but we see, for example, other factors that are indeed attractively high. This specific moment, for example, the return on equity and the return on capital. The basic principle in finding the best stocks or dividend stocks is always to invest in high quality companies, preferably the industry leaders. In other words, the best companies in that industry, the best companies in that industry, because that simply increases the chances of success. But let's say you find such a great company, and it also scores high on the factor analysis, because the factor analysis mainly focuses on the short term where the momentum factor carries a lot of weight. Then it could be that you have a winner. You've done a lot of research, you've been patient, you've done your research, and you think, okay, interesting. One of the features in seeking alpha is dividends. Here we see an overview of dividend safety, dividend DEGIRO, dividend yield, and dividend consistency. We have now filtered for dividend stocks using quant rating. And one of the more important factors in this systematics for dividend stocks, specifically, they also need to score high on dividend grade. And that's why the stocks are filtered in. This specific filtering methodology also pay out high dividends, but especially for the longer term. So there are 4 different factors, and they all need to score high in principle. If it doesn't do that, then the company might score high on the factor analysis, but it won't make it onto this list. Then it might come in, I'm just saying, a general list of all stocks. Then we find, for example, here, can we quickly find a company? Let's take this Grupo Super as a company. Well, it scores very high on the factor analysis, almost a 5. You see, it pays out dividends, but we don't find this company in our dividend overview. That's probably because it doesn't pay out dividends consistently. How do you see that? For Ingredients, for example, you mainly want to look at the dividend history. What is the dividend policy of this company? For that, you should read the annual reports and you should definitely go through the annual statements. You also need to look at the management. Does the management have a lot of skin in the game by owning a lot of shares? Or at least 5 years of annual statements converted into shares? Those kinds of things are all very important when it comes to quality investing. And investing in dividends is definitely about investing in high quality, because these companies often pay out dividends where you need to invest in high quality, because these companies often pay out dividends, but many of those companies aren't growing much anymore. So they pay out a portion of their earned income as dividends. So yes, that's not always a long-term guarantee. Good luck. So you have to be very critical of companies that are not only very strong, not only paying dividends, but also consistently growing those dividends. In the case of Ingredients, we see here, for example, that the number of years of consecutive dividend growth, 0. So something probably happened that interrupted this series. But we do see that they have been paying dividends for 20 years in a row. So that's a positive thing. Well, here you can investigate, when has a streak of dividend growth been interrupted? You can see that they are paying out just a little bit more in dividends each time. So some decent research is needed here. But we actually see that the dividend in 2024 is on track. So basically, the same as in 2025. So actually, the streak was broken in the past year, but in the other years before that, we also see similar numbers. And yet, we do see that gradually from 2014 as an example up to 2025. Gradually, the dividend is indeed increasing. So there is indeed dividend growth. You don't see that so quickly in this metric. That's why you need to take a look at the dividend history. So this is a very simple way to look at it. Well, is it interesting now? Intense, this is still in the short term, 6 to 12 months. Another tool I use for that to see, okay, what could it be just purely for inspiration for the next 3 years? For example, that's Fast Crafts. Fast is very useful for dividend companies that have been paying dividends for a long time. Why? Because Fast Crafts is mainly fed by historical data. New companies, just with the IPO, they don't have historical data, at least not on the stock market. So yeah, then Fast Crafts doesn't work. But Fast Crafts works really well. I personally find that from my experiences on companies with a long stock market history, and we happen to see that in Gradian. Fortunately, I chose a good stock as an example because it goes back to 2003. Well, this is super interesting because actually, a short summary of the story is that this price level, the black line, as long as it stays below the blue or the orange line, then the orange line, then could it possibly be undervalued in the short term? But you should always look at the orange line. Let's take a look at the next 7 years. You might also want to zoom in a bit on 7 or 5 years because then you have more recent statistics that the model works on. And the figures that the model works on are the earnings per share. Earnings per share. Well, if you zoom in on 7 years, you suddenly see a difference. The blue line is the normal multiple. This is actually what the market is willing to pay taken. Immediately off the 7 years, and we see the fair value line. That's actually what Warren Buffett would describe as intrinsic value. This model uses a price earnings of 15, taken from the price earnings of 15. And the difference between this model and, for example, an experienced investor like Warren Buffett, or maybe even you, is that you calculate your own intrinsic value. And that's obviously much better. And then you might end up with, yeah, just a moment. This company may not have performed well over the past 7 years, but is expected to perform better in the coming years because they have implemented new product innovations or new expansions, and they have improved the model. Yes, then you can use a higher multiple. So doing your own research, thinking for yourself, and creating your own forecasting and intrinsic value scenarios is, of course, still very important. But in this case, we took ingredients, and we see here, for example, the price to earnings is around 13, and for next year it's 12.5. We also see that the 5-year average of Ingradio is higher, namely a bit higher. What does that mean for the forecasting? Well, at this moment, we see that the price to earnings is indeed 12.7. So this is also correct in this model. And below, we see the EPS estimates. And analysts think that it's going to rise. Well, you always need to verify this. Is this correct? Based on your insights, it really looks like the profits are going to rise. And looking ahead for the very long term is difficult. I think for the short term, then you can make a better assessment. So I think that's also the reason why the fast crafts just take the next 2 to 3 years. Because yes, then you have a bit more certainty for an assessment. But often we all get it wrong. So you always have to take principles into account there as well. Like margin of safety. Margin of safety. You've already established that in Gwydion, they offer a relatively attractive dividend for you. You also think it's a good company. And is this a good time to buy? Instead of making decisions based on technical analysis, you can just do it based on potential undervaluation. The price earnings ratio is indeed below the fair value of 15. There is a certain profit per share. And when the profit is realized for you, then we will see that Inquidian could theoretically achieve an average return of 17%, including dividends. That means you could potentially beat the S&P 500 with a simple dividend share. Let's stick to the normal multiple. In some way, the market says, well, I prefer to pay 13 times the normal multiple. And we can actually see that it's been like this for a while. Maybe one time, bottom. So basically, we need to stick to a lower multiple, and then we are a bit more on the safe side. And for us, we see that we can achieve an average return of about 10%. And of course, when we see this, then it's not interesting enough. So where are you saying that to ingredient? No, because Anyway, Ingredient is not a superior company. So based on that, we want to pass for the long term. And for the short term, it does seem like a strong buy in the short term, only possibly not interesting enough. So if it's not super interesting from the first insight, then you might as well use your brain capacity for other analyses. Let's move on. So then you go back to the filter list, you look at other potential lists, and this is basically what I do all day in a nutshell. For our company, well, so you can try Seeking Alpha, and we also have a discount link for Valsacrafts in our YouTube description. For both, we receive a compensation, but that doesn't cost you anything. Extras. So we receive a compensation, and we would really appreciate that if you want to give it a try. The only but is that Seeking Alpha costs about $250 a year, paying with credit card or PayPal. Fastgraphs costs more if you also want European stocks. In this case, I also have European stocks, so I'm spending about €700 a year. If you only want the USA market, then I think it's 200 or 300 euros. But in total, you're still spending 500 to 900 living. Up to 900 euros spent. Now, a little hint, we also offer analyses if you're interested. The dividend stocks, and we try to look for strong dividends stocks. So mainly focus on the long term. And we indeed use the factor analysis from Seeking Alpha. We also apply a bit of technical analysis, but only for the very short term. But much more importantly, we do in-depth fundamental research on, is it a good company from a strategic perspective? So it has a strong upside advantage to succeed in the long term. And of course, we mainly look at the factor quality. We also make recommendations and provide a monthly overview of top stocks, which we think are an interesting option is, and we do that for just 99 euros per year. So you can always give it a try with us to see if you like it. Or if you say, well, I prefer to do it all myself and invest the time, then it takes a lot of time. But then you also have more extensive futures by using a stock screener like Seeking Alpha or maybe even Fastcrafts. It's up to you. With us, you get it for 99 euros per year and you can try it out for 14 days. 100% that you get your money back if you don't want to stay. What does that look like? You click on sign up, start trial period. You join our community. It looks like this. You'll get to see the very first analyses, value, DEGIRO, dividend stocks. We also provide buy and sell signals for as many stocks as ETF shares, and we have countless options that you can follow. By the way, all of this is also available for a relatively low price. If you have any questions, you'll find it here. The channels for the community. Do you have questions about stocks? Then you go to the community stock, ask your question. And this is how we help you further with a bit of online guidance. What also comes with this chain, of course. That's about finding the potentially best dividend stocks. You probably have never heard of this before. And it's really about the combination of these two programs, Seeking Alpha and Fastcrafts. There might also be other programs that you can use. But personally, I have very good experiences with the quant dividend stocks. And that's a very simple list. It's filtered every time. And in this case, I bought Vision Properties myself. It's been very high for a while now. But my first positions were from a few months ago, and luckily it still remains high. But while this doesn't really say anything, you also look based on other valuations, creating your own insights. Let's say scenarios for the intrinsic value insights, and let's say scenarios for the intrinsic value, because basically we don't want to lose money. And investing in dividend stocks is by definition a bit lower risk than, for example, high risk stocks, DEGIRO A stocks. In my portfolio, I started at 23 with a lot of growth. Stocks, I took way too much risk. If I look back and I could give myself advice, I would just start with much lower risk. Let my assets generate returns. And in the meantime, learn a lot more about stocks because it is super interesting. I now have so much wealth that I don't need to take too much risk anymore. So I will also increasingly take a bit of dividend stocks, still a bit of dividend stocks, maybe include it. But I say it with an emphasis, maybe because by definition, I actually just want to primarily invest in growth companies. And I actually think but nothing that they pay out a part of their money as dividends. You actually only have to pay out the money as dividends. If you can't find a better way to reallocate your money for your shareholders, then ideally you just want the company to take all its profits and reinvest them back into the business. Because we see that here, then you get the return on equity and the return on total. If they are super high, let's say structurally above 15% per year, and you find that with great companies, let's take Alpha for convenience, for example. Of course, Alpha is known from Google. We see that AH here, return on equity is 32%, but the 5-year average is 25%, and the return on total capital is 16%. And probably over the past 10 years, that's also around 15%. Actually, very weakly taken. Does this mean that if you buy Alphabet at fair value, so around the fair value, then your return would simply be 15% per year? And that 15% is going to compound every time. So you get 15% of 15% of 15%. And that's how you create financial growth. And that's how you become financially free. So I prefer that we invest in great stocks and that they simply reinvest the dividends into their earning model. But sometimes you just have companies that pay out high dividends and seem to be quite undervalued. Yes, that's possible too. It turned out wrong, but that's of course a personal choice. And that's entirely up to you. Thank you for watching. I would really appreciate it if you could subscribe to us and like the video. Like, if this helped you, great. If you didn't like it at all, that's good too. Totally up to you. You can also give a thumbs down. I don't mind. You have to do everything because you stand behind it. But anyway, I want to thank you for your time. I hope this has helped you. And if you have a question, let me know and I'll be happy to help you further. And I would say, until next time,